Hi, this is Dave Senkfor with Top Gun Consulting, and I'm going to walk you through a quick evaluation of a company. These are made up numbers, but just to give you an idea of how the whole process works. Hi, this is Dave Senkfor with Top Gun Consulting, and today we're going to talk about a business valuation example. And we're going to use some generalized numbers, just some numbers I've made up, but nevertheless we're going to go through this and try to figure out how much a company is worth. I'm going to go through it in terms of the possible sale of the company, although there are other reasons to value a company, such as possibly just getting a number for a transfer of a sale to other family members, or possibly you're getting some additional partners and you have to have a value for the IRS. But in most cases, a value is determined based on the fact that you're thinking about selling the company. So, what do we talk about when we get into that? Well, we talk about the seller's discretionary cash flow. This would be the money that's available to the seller on a year-to-year basis, the money that they actually either get or keep in the business. So let's talk about a company that might have an annual sales of about $10 million. They're bringing about $1 million down as pre-tax income. And that's a good number to start with, but we've got to add back things that have been taken out and also some of the other cash flows that the seller has on hand that they've been taking advantage of. First is the interest payment he might have on any debt, put in $10,000. Some depreciation on the equipment that they have in the plant, put in $100,000 here. And we do have to, though, take away any potential allowances for some capital expenditures they might have during the year. I just put in $10,000 as a placeholder, but clearly I think most would agree that you're going to be spending some money and you have to take that into account. Lastly, we have to get into all the other costs that the seller is getting out of the business, and that would be his salary, possibly a car allowance, cell phone, any other family members and their associated expenses. In this case, I'm just thinking maybe one member and some other expenses totaling $200,000. And at the end of the day, we have our seller's discretionary cash flow of approximately $1.3 million. So what do we do with that? Well, we take that number times a multiple to come up with a sales price. Where do we get the multiple? Well, they vary based on generally from 1 to 3. A lot of factors that would affect that number, but a lot of them have to do with the risk of the business, how valuable that business is to somebody who might be thinking about buying it, and some other factors that we'll get into later. But in any event, generally they're from 1 to 3. They can be higher if the business is a high profit business. But nevertheless, we're just going to stick with a number that's between 1 and 3. So in this case, I've just picked an average multiplier of 2. You take that times the 1.3 million, and we come up with a $2.6 million sales price. Not bad, but what if we're not happy with that number? What do we do? Well, the first thing is to raise the net income on existing sales. And how do we go about doing that? Well, frankly, there's only two ways. One is to either raise your prices, which may or may not be possible, and keep your existing percentage of net, or you have to cut your costs, another good way, and again that will affect the dollars that you're bringing down to that income level there. The other thing obviously is to grow the top line, grow your sales. I'd recommend kind of a combination of number 2 and number 1 here to maximize the top line as well as the bottom line as well. Third thing is decrease the risk of the business going forward. This is kind of an attempt to work on that multiplier. One of the things that's important is if you have key personnel that the business is very, very dependent on, possibly the owner, possibly other people. So if they can be replaced or supplemented before the business is sold, that would take that risk out, that once that person is gone, the business starts to fail or whatever. But bottom line is you don't want to have all the business wrapped up around 1 or 2 people or whatever. The other thing is sales concentrations, either in products, markets, or customers. Any of those will give a potential buyer a little problem, because they want to they don't want risk of losing any of that concentration of product to somebody else if most of the business is focused in just a few areas or with a few customers. On the other hand, one thing you can do is you can get into proprietary products or manufacturing methods, so you get a hold of the products or the method to make a specific part, and you get kind of locked in on certain types of jobs. So that's kind of how it works. Obviously, there's a lot more to this thing. I got a couple. You just have a caveat here, and again, it is a very simplified and approximate example valuation process, and I would encourage you to not use this as the final determinator of your value of your company based on this short presentation. But if you have any more questions, please contact me at Top Gun Consulting, either at my email address here on the slide at david@topgunconsulting.com, or give me a holler at 602-510-5998, and I'd be happy to talk to you about what the next steps might be in your process. So I hope I've given you a little food for thought about the value of your company, and hope you're having a great day. Thanks.